Good morning, everyone. Hope everyone's well. I hope everyone's managed to get a bacon sandwich and a coffee. Thank you very much for everyone for coming. It's really good that we can have this much attendance, and today being 3 years since the first lockdown, I think it's amazing we're all in the same room together. I think it's to be celebrated. So today we're going to talk to you about the budget. What I just want to give some clarity on, well actually let's introduce everyone who's going to talk to you first. So I'm Josh Curtis, I'm one of the partners here at A4G. One of my roles is to, well, on budget day I sit there, read the budget, listen to the budget, and then read the thick document that they release from the Treasury, along with my colleague Janice, who's our CTA qualified member of staff, and together we analyse what's going on and try and work out the reality for our clients. Emma is also one of my partners at A4G, and she's the head of our advisory section, so she tries to develop how we turn those bits of analysis into action plans for our clients. And we're also joined today by Matt from the FSB, who's going to give us his views on what the budget means for small businesses. So just a disclaimer, it's going to be a bit of maths today. I do apologise for that. You don't have to do any arithmetic, you're fine, but there will be some numbers that are small. But if you can't read them from the back, you'll have to trust me. But we will be releasing bits of the presentation, so you should be able to see how we've done our calculations if you are that interested in my spreadsheets. So what difference does the budget make to small businesses? Well, the budget had one main ambition, and that was to be as boring as possible. After the madness of last year, I think Jeremy Hunt's hands were tied behind his back. There wasn't much that he could do because they tried doing mad things last year and it went pretty horrendously. So I want to explain, whenever I watch the budget, I have this thought in my head, and it comes from, bear with me, I'm not a gamer, but these terms, nerf and buff, come from the gaming industry. If you develop a game and you've got characters in the game and one of them just completely defeats another one, you have to reduce the power of that one and increase the power of the other one. When you reduce the power of one player, you call it nerfing, because that is like a Nerf gun which fires those little foamy, anyone with kids who's got one of these, where they fire foam pellets at you. Okay, in theory they're not very effective. I'm sure you don't really want to be shot by a foam pellet. And then buff is to make it stronger. So I've chosen a picture of Arnie in his prime to show being buff. And so really, when you go through the budget, you're thinking they're taking bits of the tax system and they're weakening some bits of the tax system and strengthening other bits. So when we look at the main announcements, well, I say announcements, they didn't really talk about the income tax rates, even though they are being frozen again, which when inflation's running at 10% is quite a significant tax rise. National insurance is back to its previous levels after all the health and social care levy that they introduced and then backtracked and then couldn't be bothered to put it back in again. But rather cynically in my view, they did not return the dividends taxes back to their previous levels, even though they were tied together when they were brought in, which is a frustration for small businesses all over the place. They did very quickly just go, oh yes, and 25% tax rate for companies is still going ahead, but didn't make much of a fanfare. And then at the end, the big announcement was that pension rules are being released, which is an amazing bit of relaxation of the rules for some, but that's about all he could do. So using my terminology, income tax bands nerfed, they're not, personal tax, it's not as good as it was, it's been weakened. National insurance levels going back to the old level, that's a bit of a buff, that makes that a bit better. But then dividends taxes, they remain nerfed, using my language there, and corporation tax, companies are nerfed, they're made less effective. So if you look at this, actually income tax, that affects companies, dividends, that affects companies, corporation tax, that affects companies. So I'm afraid, for a lot of what I'm about to talk to you about, is about how companies have got a bit of a hit in the UK tax system. Now the budget really covers three pillars. Just a quick show of hands, who in the room represents a company? I'm not representing a company. And who represents a partnership or an LLP? Okay, interesting. And obviously individuals, that affects everyone, whether you're an employee, a consumer, that's the side of tax. But what we're going to focus on is this first pillar, limited companies. So this is the tax rate that limited companies have enjoyed for the last 5 odd years, and it's going up to 25%. That's the headline. But actually, the highest rate of tax that a company will pay is 26.5%. And that is because of the way the taper relief works. So the rules are that you can earn £50,000 of profits in a company and pay 19% tax on that bit of profit. If your profit then goes over that, it stays under the 250,000 threshold, that element is gradually bringing up that 50,000, so it gradually creeps that percentage up until it reaches 25%. And the effective rate of tax is 26.5. So if you're trying to work out an estimate for your corporation tax in a company, and you think, right, okay, this year we're going to make £100,000 of profits, you've got to split those profits between those two effective bandings, even though that's not how it's published. That's the easy way of calculating it. The actual calculation we have to do on a tax computation is a lot more complicated than that, and it uses all sorts of formulas, but that's the easy route. If your profits exceed £250,000, then you just apply 25% to the whole lot. That's the headline. So to explain my calculation for 26.5%, you take your 50,000, times that by 19 for £100,000 profit, add your 50,000 at 26.5, that gives you £22,750,000 of corporation tax on £100,000 of profit. That means the overall percentage of tax you're paying is 22.75%. So when you look at the total and divide it by the profits, that percentage doesn't sound as bad as the full 25% headline that they give you. That's because your tax is being tapered, gradually eked up to that 25%. But the reality of it is every bit of profit you earn over 50,000, you're paying 26.5% on it. And that's obviously not what they publish. But this is like taking the red pill in the matrix. This is what's really happening underneath those rules that they announce. And I'm very sorry about this slide because it scares the hell out of me. The worst possible tax rate in the 2023-24 tax year that a limited company owner could pay is 63.71%. Now this is on the basis that the company is earning more than £50,000 of profit. So for every £100 over that, you're paying the 26.5%, and your personal income tax band is within this horrible region of £100,000 to £125,000. When you're within that bracket there, you start to lose your personal allowance. So for every £2 over £100,000 you earn in taxable income, you lose £1 of personal allowance. And that gives us a very horrible dividends tax rate. This is how it works out. You get 100,000, you've got to pay 26.5% corporation tax on that. Leaves you with an after-tax profit of £73.50. You draw all of that out as a dividend. That's the assumption. You're drawing every bit of profit you earn. And then that is taxable on you at 50.63%, which is a horrible number, even if it wasn't a high number. And that means the effective rate of tax on this calculation is 73.71%. Just so that I can explain that a bit further, this is how we come up with that very strange tax figure. So for those who earn their income from dividends, if you've got £100 of dividends and you're starting to lose your personal allowance, because you lose for every £2 of income over that, you lose £1 of personal allowance, you get the 100 is taxed at the higher rate of dividends tax, 33.75%, but you also lose £50 of your £12,500 of personal allowance, and that gets added to the higher rate. So you effectively get £50 extra into the higher rate as well, and that's how you end up with a horrible tax figure. So for £100 taken, you pay £50.63 within that band. So the general rule I would say is if you're going to draw more than £50,000 from a company, go up to 100. If you need more than 100, go well above 100 to try and nullify the effect of this horrible tax band that no one tells you about. Employees and self-employed are not immune from this though. The number is actually a little bit worse in some ways. So for an employee, £100,000, you get the £40,000 tax rate, 40% tax rate on that 100, and you still lose the 50 from the personal allowance jumping into higher rate, so that then taxed at 40 as well. So that means you're actually paying 60% as a self-employed or an employee who's in that horrible £25,000 bracket, just over 100k. Now, in the previous slide where I said that the company rate, the effective rate for an owner of a company is paying 63.71, a self-employed person in that bracket would actually, you've got to add 2% national insurance to that, so they're paying 62%. So you can see there's a very marginal difference, but actually it starts to weight on the side of the self-employed. So what's better, a limited company or a partnership. Now, when I started my career, we used to always say that, at about £35,000 of taxable income, a limited company always beats self-employment, and the tax saving will nullify any additional admin expense for running a company. Because a company is more complicated to run. You've got to file with the Companies House, you've got more red tape, more legal stuff to do. Whereas a sole trade, you can just take the figures and put it on a tax return in some cases. But now, at £35,000, a limited company only saves £302 compared to a sole trade or partnership, which isn't very much and isn't going to compensate the additional admin. Now, of course, I'm ignoring the fact that limited companies, you have the benefit of that legal entity being separate from your personal entity, and you could also argue that an LLP gives you the best of both worlds in that. But so if we look at that, so that's £35,000 of profit. A limited company isn't going to be very effective at saving tax. Now, this strange number, £60,013 of profit, there is a reason I'm showing you this very strange number. At this point, a limited company is more efficient in tax savings than a sole trade by 2,234. So that's starting to sound a bit more like it. It's still not as much as you want to compensate the complexity of a limited company, but that's better. Now, the reason I've chosen this number is because when I went through all the numbers in my spreadsheet, this was the maximum amount of savings a limited company would make. Someone who's drawing all of their profits, which isn't very much. And then the next strange number I'm going to give you, which is the one to remember, at £84,025 of profit, there's no difference. A sole trade or partnership is making the same amount of money, so paying the same amount of tax as a limited company, where in both cases you're drawing all the money out. So when I say limited companies have been nerfed, this is what I mean. Partnerships have now got a strength to them because they can compete in terms of tax savings with a limited company. So in both cases, just on that profit, that would allow both a sole trader, partnership, or a limited company for them to draw out 67,919. So let's call it 68,000. So I'm very sorry that I've scared you with those numbers about limited companies. And I'm now going to pass to Emma, who's going to take that a step further, to now look at what we can do planning behind that.
Wonderful, thanks Josh. So we're going to keep all the scary bits at the beginning, and we promise there's some better stuff coming towards the end, because I don't think my news is getting any better, I'm afraid. So just to work that through in terms of some examples. So I've taken an example of a sole trader with sort of turnover of 75,000, net profits around 55, and a net margin of 73. So if we work that through, assuming taxable profit remains the same and has done for the last 3 years, as you can see, the income tax has remained the same amount. The national insurance, slight increase in class 2, but actually a reduction in class 4. So by the look of things, the net income is about the same, everything's fine. But actually, what does it really mean? The tax bands are frozen, so that is a real term decrease. So the challenge for sole traders is obviously combating inflation within their prices. And I think particularly when you're a sole trade, it's so much harder to put your prices up when it's you as an individual. Small impact of obviously, if you are going to increase your turnover, you are going to then push more of your net income into higher rate because the bands have been frozen. So actually, if we work that backwards in terms of a real term equivalent net income, a £41,000 net income last year is the equivalent of 37 this year. So that's a 3,800 reduction in sort of income, because effectively your money's not going as far. So for sole traders, you've got the slightly better end of the deal in terms of your focus is sort of combating inflation within what you're doing. So what I always think is quite practical is to actually work that all the way back to turnover, because it's really important that you understand what your numbers need to be on a monthly basis. So if we take that example where net profit is 55, if we up that by inflation, we're then looking at 60,500. If we work that all the way through to turnover, you were turning over £75,000 last year, it needs to be 82 8,900 this year. So that's an increase of £8,000 you need to put on your turnover to actually stay still in real terms. So then for a lot of people, they've got limited companies. So with no employees, I've looked at your sort of typical husband and wife company where obviously you get to take advantage of, if your wife's not working or not fully working, you can use some of her tax allowances. So if we look at a turnover about 150, net profit at 120, and a net profit margin about 80%. So those examples, you can see just from the tax impact alone, the net figure has reduced slightly. That is impacted mainly by corporation tax, but then obviously corporation tax has reduced the amount of take home for all of you. So actually as an individual, that a company like that, they've already reduced their net take home as individuals by nearly £4,000, and that's without allowing for inflation. So what that really means is obviously there is a huge increase in tax burdens for limited companies with the marginal rate at 26%. You've got to fight inflation as well as tax increases. Obviously you're all impacted by rising costs. So the real term equivalent net income at 90,000 is 90,000 based on the previous year. So that's actually a 13,418 reduction. So again, if we work that back through some examples, so last year, or sort of the current year we're in, £150,000 turnover, 120 net profit, corporation tax at 19%, and a net income of 97,000. So if we then inflate that 97 to 107, the corporation tax on that has had a significant jump to £35,500 at the marginal rate. Your net profit has then got to take a jump to 142,000, and your turnover has got to increase to £178,000. So that's a 19% increase on your top line to combat inflation and tax rises. So the more typical clients that we deal with are limited companies with directors and employees. So if you think of your two-man director and your sort of 10 employees, our experience of companies like this is often they put employees' income above their own, and they'll work out their stuff at the other end. So we've assumed that 2 directors, 10 employees, and a combined salary bill for the employees at £350,000, and a net profit margin at about 30%. So that's like your more typical service business. So if we work through those examples, obviously what we're looking at in the current year is to pass on those inflationary increases to staff so that they are still motivated. You know, that's going to cost an extra 35,000, and then because of the increase in the cost of that, it increases the national insurance paid by a business to employ those staff. Then you've got a jump in corporation tax of nearly £9,000. So the impact on the amount of money that's available to distribute to those directors has dropped from £242,000 to £196,000. And then you add on that dividend tax, and the net income of those 2 directors has dropped by £23,000. So that's a £10,000 drop per director. Now, you know, I'm sure most of you sitting in the room aren't sitting there thinking, actually, my house is a bit big, I earn too much money, and I'm not concerned about this stuff. So again, it's the increased tax burden, it's having to have a plan to combat that whilst combating inflation as well, the rising costs that are a bit out of control, and the salary increases that are being asked of you as business owners to help your staff pay their cost of living. So as I said, a big increase in corporation tax there, and then if we work through the example to match the same take-home equivalent, so as I said, £1 million turnover, net profit at just under 300,000, corporation tax at the 19% for the current tax year, which would be nearly £57,000, and we've got net income of 242. So we inflate that to 266,000. We add the corporation tax increase. We take that through to net profit and turnover. And again, it's a 90% increase just to stand still. Now, I know how I felt when I worked these numbers. It made me feel a little bit sick. Then it made me feel really angry, because I deal with a lot of businesses and I'm angry for them. And then it makes me feel a little bit sad, because I know that the businesses that aren't aware of this will be the ones that potentially fail, because they haven't factored in these increases. And really, from my point of view, the crunch point, because the new tax rates start from the 1st of April, for March year ends, you won't have to do accounts till March 24. The corporation tax bill, which will have increased significantly, doesn't hit you till January 25. So that is crunch point. And the businesses that don't understand this and don't do anything to change this will suffer some real pain at that point. So I'm sorry to be the bearer of bad news, and I'll be back on to talk about the way we work on actually what do you guys do to action some of this from a practical point of view, so that it isn't a surprise in January 25. I'm going to pass you on to Matt from the FSB to give you his sort of overview of how small businesses are being impacted.
There's only one slide, just next to which one is that? Start with an icebreaker. Nice to see you.
Nice.
Right, general theme of the presentation probably go downhill from that point, but I'm just going to give you a real blow by blow of what small businesses thought of the budget, or we FSB thought of it. So we went into it thinking that particularly confidence among small businesses was low, inflation running rampant, taxes going high, interest rates going up. We needed a budget that had an element of optimism, and we didn't get it. It was a real missed opportunity, we felt, from the Chancellor when he stood up. There were some wins. We saw fuel duty stabilise and a hike not going up 5p, cut not being going back up, so that was welcome. Seed enterprise investment schemes and support there in terms of if you're investing in tech startups was kept. And likewise, there are some announcements on childcare that I'll go into that were half welcome. And also the R&D tax cut that he was going to bring in last year, he sort of reversed it somewhat, but again, it very much felt like it was aimed at large businesses. And that's the crux of this issue, that it was felt that small businesses were left out, large businesses won heavily in the budget, small businesses didn't. So in terms of when we started with the taxes, there was nothing in there in terms of business rates. We wanted to see the threshold where you pay business rates increase from 15,000 to 25,000. There was nothing in there on that. The VAT threshold that's been in place at 85,000 for years now, we wanted to see some movement in that, because we feel that businesses go straight up to that point, a lot of them mainly only working 4 to 5 days a week, because they don't want to go above that threshold. So that was another area we missed. But the big one, on capital allowances, really giving a £27 billion tax cut to large businesses to kind of outweigh the corporation tax increase and the super deduction being removed. He's introduced 100% of capital allowances on plant and machinery, 50% on lifelong assets. These really focused on large businesses, not small businesses. So that was really disappointing in that area. The other area we wanted to focus on was the labour market. It was attracting talent that we wanted the government to really focus on. And again, this was where the missed opportunity took place. Whilst there was an announcement on extra funding for childcare providers, that kind of top up, and 30 hours of free childcare if you've got 9-month-olds to 4-year-olds, which is welcome. The problem you've got is that providers, there are a lot of small businesses, a lot of nursery providers, particularly in the area of Kent as well, who have faced significant challenges in providing that free childcare, which makes it even harder for people to access the hours they want, because providers have to find a way to top up that amount. If the funding wasn't there originally, we're concerned it's not going to be in place when they introduce these extra hours. So that's a challenge to start with. Secondly, there was a welcome announcement regarding these kind of returnerships, as he announced it, the opposite to apprenticeships, getting the over 50s to come back into the workplace as a result of the pandemic. So that was welcome, so extra funding for like skills boot camps for the over 50s, which is good. But there was nothing in there to really, or not at length, to support those who've got disabilities, long-term conditions mental health conditions going to start their business. A lot of our members have said, or a lot of people out there who have got long-term conditions, disabilities, mental health issues, want to start their own business, maybe not necessarily go into work in a business, but yet there was nothing in there in terms of a kind of an enterprise allowance to support people who wanted to start a business. And likewise, we would like to have seen a kind of a kickstart scheme whereby you support small businesses taking on people who have got long-term conditions into their workforce. So that was, again, a missed opportunity. And the fourth segment of the labour market was the immigration issue. There was an announcement in there that there's a shortage occupation list. So where the government sees a concern in terms of not getting the talent we need, they put in place a shortage occupation list so you can attract the talent from abroad easier than the current immigration system. And that was put in place for the construction sector. But again, nothing there to support, particularly hospitality, retail, leisure industries who need to attract the talent. So we'd like to see that shortage occupation list increased. Third point, energy. There was an announcement in the budget to increase the kind of maintain the 3-month level whereby you don't get bills above £2,500 till July. Again, welcome for the individuals. There was nothing in there to support small businesses who have been put on fixed contracts from August last year. They'll see bills going up 2, 3, 4 times their amount come April the 1st. So there was nothing in there. So you've got the individuals winning on the energy side, you've got the large businesses winning on the capital allowance side, but nothing in there for the squeezed middle small businesses. That was a real concern. Government also pushes the net zero agenda that small businesses are behind. However, there wasn't anything in there in terms of a help to green voucher that we were calling for. Support if you're looking to upgrade your vehicles or upgrade your boiler systems or even green your business. We thought there should have been a voucher system in place to help those businesses, and lots of other businesses were calling for that, but nothing announced in the budget. Fifth issue, which I'll just touch upon, is the local support. There's the likelihood that there's going to be a consultation on the disbanding of local enterprise partnerships, and that will be amalgamated into local authorities. But London and the South East didn't do particularly well as a result of levelling up funding, regeneration funding, even though there are high pockets of deprivation that could use support. But unfortunately, government's agenda is to level up other parts of the country, but level down pockets of London and the South East, and that shouldn't be the area. The focus should be on levelling up all parts of society. So apart from that, some elements of good news as mentioned at the start, but our work continues now as FSB. Tim and myself work on the kind of the lobbying advocacy side, and one of the big issues, just to kind of wrap up here, is that funding is going to be a big issue this year and moving on. We only need to see what's happened with Silicon Valley Bank, with Credit Suisse, that when banks start to see these threats, they start to recapitalise and they stop lending to small businesses. It's happened in the past, and the fear is that happens again. We need to quash this. We need to make sure that small businesses remain liquid, that they can get the funding they need, because if they don't, it leads to stagnation, it leads to businesses not being able to be a going concern. So it's in the areas of accessing finance through banks, is in the issues of particularly the scourge that is late payments by large businesses not paying their small suppliers on time. It's that liquidity, helping small businesses, that's going to be the focus on this year. So yeah, I will hand back to Josh.
Thank you very much, Matt. I agree with everything you've said there. It does feel like most of these budgets all seem to be supporting big business, and they seem to forget about small business. So I think we as small business owners should be more than just a bit cross. So what I want to try and do now is try and move away from the gloomy news that we've had there and try and look at what positives there are and what things we can do that actually can make a positive difference. So to return to our limited company versus sole trade partnership equation, there is a question. So all my assumptions in the first half were about if you draw every penny out. Where a limited company starts to come into its own is if you don't draw every penny out of that business. So if we take some examples where we cap the earnings of the shareholder of the business at £150,000, let's just assume it's a single shareholder company. So they're drawing £12,500 a month, they're happy to live on that. But the business is making a £250,000 profit. So we're now fully into the 25% tax rate. Because they're not drawing all of the money out of this company, it now saves tax compared to a sole trade. The reason being that a sole trade or partnership always pays tax on 100% of its profits at the individual's marginal rates of tax. So if you're making £250,000 of profit, the top slice of that is all taxed at the highest rate of tax for the individual, which would be the 45% band plus the 2% national insurance. Whereas a limited company, it's only paying 25% on that undrawn profit. If, again, earnings capped at 150,000 and the company is now earning £300,000 in profit, the savings now start to ramp up. The company is now £13,500 better off tax-wise than being a self-employed business or a partnership. And then if we look at I've stopped at £500,000 of profit. At this point, you're now saving just shy of £60,000 of tax every year by retaining that profit in the limited company. So all is not lost for a limited company. And that retained profit might not just be cash. This could be that you've invested in stock, you might have that you're investing in assets, you might have slow paying debtors. This all then starts to pay, to work out that there's a tax saving to be made, rather than you have got tax to pay on profits that you may not have yet received the cash for if you were a sole trader. But this then leaves one question. You've got money locked in a limited company, what do you do with that? So if on the lower one of my examples, £250,000 of profit, drawing out 150, that means every year there's about £40,000 of cash trapped in this company. On the highest one, if you've got £500,000 of profit, £150,000 of drawings, you're now looking at just shy of £230,000 of cash locked into that company. So what are you going to do with that? Now, on the basis that lifestyle costs are all taken care of in the drawings, that leaves you with some options. So effectively, this is going to become a combination of your safety money for the business. If we do go into a downturn or the business starts to struggle, that's a cash flow that you can inject in the business. But it also is an opportunity for you to invest that money. Now, you can invest that money in various different ways. So we haven't really talked much about the pension release that was announced. So now that from the 6th of April, you can put £60,000 of your hard-earned profits into a pension, and that would save corporation tax. So if again we use the 26.5% marginal rate band for a company, that's going to save just shy of £16,000 of tax by putting that in. The money then goes into a tax-free environment, and at the moment you can get hold of it at 55, although that age may change. I think it's under review. And it's protected from the business, which is one of the biggest things that I always talk about pensions with. By putting the money into a pension, you've earned the profits in that year, and then you're protecting it in a pension. So the downside being you can't put the money back in, but at least it's your money now, and the business can't just hoover it up. And if you're using unused allowances from previous years, so if you haven't used the £40,000 allowance for this year or the 3 before, then actually you could put something like £180,000 into a pension, and then the tax savings are nearly £50,000. So this is an area where I'd recommend talking to an IFA. Maximising pensions, if you've got the profits to do so, is a really good bit of tax planning, and quite a simple bit of tax planning to do. The other option is you could invest that money in your business. So often the first thing that people think of is they want to invest it in property and things like that. But I think that there is something to be said for investing in your own business. The investment you have that you know the most about, and have almost daily knowledge on how much that business is worth in some form or other, is your own business. So if you've got this additional capital that you have that you want to invest somewhere, it might be a good idea to invest it in your own business. If you update your plant and machinery, the annual investment allowance will mean that anything you invest in assets for your business, you'll get that allowance in the first year. So it effectively gives you the same allowances as the pension for anything that you invest in that way, up to £1 million a year. But I'd say most small businesses wouldn't exceed that. I think we've got a couple of clients where they've got some very expensive assets they buy occasionally, but generally that £1 million limit for the annual investment allowance suits their needs. Now, Matt touched upon research and development. If you have got some money aside and you think, right, I would like to explore this new avenue of business, and it's applicable to research and development criteria, so you're advancing something, it's not something that someone else has done in the UK before, it's pushing some form of technology, we have a team who can help and talk about, analyse what projects you've got and see if they're applicable for R&D. And if they are, the expenditure that you have gets uplifted by 86% as a small business. So if we look at it, if you spend £50,000 on costs that are R&D applicable, then they'll get uprated and the tax man will pretend you've spent £93,000. And so actually by spending £50,000, you'd save just shy of £25,000 at the marginal rate. So it can be an incredibly effective way of investing in diversifying your business. You're going to track to a new way of delivering something or a new product line. You can expand your business using that money, and the government will subsidise through the R&D tax credit to sort of help you sort of compute that risk and sort of gives you a bit back, a bit like seed investment and EIS. Now the other thing you might want to do is actually diversify. So you don't want to risk any more money in your business, you want to invest it in something else. Now our recommendation usually is to, if you've got a significant amount to invest, you don't want to invest that through your main company. The risks are, if you turn a lot of your company over to investment, it might start to undermine things like what used to be entrepreneurs relief, business asset disposal relief, where you can sell your business at a lower capital gains tax rate of 10%, or it could even have an effect if your business has got a significant amount in investments. It could then mean that your business now becomes part of your inheritance estate.
Can you talk up a little bit?
Sorry, can you not hear at the back? Okay. But using a separate company, you could invest in things like residential property. There is almost no limit on what an investment company can invest in. I've got one client who's got some Rolex watches in his company and some gold in a safe. It's quite flexible as to what you can put into it. The only thing you have to do is you just need to make sure the structure of that company is right to get the money there. And also you can use that company to invest in other businesses. So some of the things that we look at is a thing called a sister company, or we can advise on things like investment companies or family investment companies. These are sort of different structures that get various different levels of complexity to allow you to free that capital up, still within a capital structure, to invest. So what you can do is you save the tax because you're not drawing it out, putting it into another company, and that can then compound that amount of money you've got there to make sure it's earning you whilst in that company. And then we then look at extraction methods after that. So now I've talked about how you can actually save money by looking after your income, and then any excess you can invest within a corporate structure. I'm going to hand back to Emma for some planning points.
Thanks, Josh. Right, could I have a bit of a show of hands about this? Out of the 19% increase to stand still, I'd like to gauge the feeling of the room as what you feel is the percentage increase that you could put on your prices in a comfortable way. So if I could have a show of hands that's up to 5%. Up to 6%. We've got no one at 19%. Okay. Okay. Well, I've made an assumption that out of 19% turnover uplift, like where does that come from? I felt 7% was probably where most of my clients sit in terms of would be the maximum that they felt that they could pass on. So that leaves 12% increase that is required from an increase in volume. So what's an increase in volume? That's either new business, isn't it? Like you've either got to be able to do 12% more business than you're doing now. I don't know how many of you in the room feel that you could easily do 12% more in volume now without any changes. Okay, or an increase in productivity. It's looking at the way you're doing things, how you're doing things, what you're doing. So I think the biggest mistake that people make as owner managers is they invest their time on focusing on overheads. Now, as a business owner, that is not the best use of your time. I'm not saying don't do it, I'm saying you don't do it. That's someone else's job. And obviously one of the largest overheads is often salaries. And we all know that can't be easily reduced. There is a process you have to go through to do that anyway. And it certainly won't increase the productivity you're getting from staff if you suggest you're going to cut their pay. And the other, obviously, biggest overhead for a lot of businesses is property. But actually, to change property or downsize, or that costs more money in the short term to do that, because we all know that we've got notice periods to give. Then you're looking at investing time in moving, the costs to get the new premises up to the standard you want to get it to. You know, you might lose staff along the way if you change locations. It all has a knock-on effect. So again, like, that's a much harder decision for you guys to be making. And the percentage saving on the rest of your overheads, I mean, what do we think we're going to save? So 1% maybe? So on 100,000, that's like £1,000. And it's certainly not the best use of your time, but I think it's often where we go to, don't we? Things get to a price point. I know I spent a couple of hours recently saving £10 on my mobile phone bill. Now, I can certainly earn more than, you know, that's saving me £120 for the year. You know, is my hourly rate more than £60? You know, I can get better return for my money than, you know, spending more time on the phone to a mobile phone company. But that's like an easy choice, isn't it? And sometimes actually as business owners, we have to do the more difficult things to be able to push forward. And as I said, considerable amount of time. This is the things that if you've got someone who's dealing with your finances, they should be well managing your overheads anyway, and really making sure you're getting good value for money. You know, cutting overheads can sometimes actually impact your business more because you're getting a reduction in service. And I think the most common thing for us is we see the wrong things cut. So, you know, in every recession we see marketing cut and training cut, because they're the things that are harder to manage what you're getting a return on. But, you know, certainly in our industry, if we weren't doing training, we wouldn't be able to talk to you about the new tax rates. And then we'd soon become out of date and other people would overtake us. And marketing, how are you going to increase those numbers without a planned marketing spend? So really what we're looking to do is, if you look at profit improvement, the easy maths are, if you know, anything you're putting on your top line whilst maintaining stability on everything else is a straight bottom line increase. Now obviously sometimes it's not as easy as just putting everything on your top line. So what are the current challenges for you? I would say the biggest thing we see is, as owner managers, you're so busy doing the doing, you're waiting to find the time to work on strategy. And we all know we can't extend time, and it doesn't find us. So we have to really be very disciplined about carving out the time to work on strategy. And there's no one better to work on strategy than you as the owner manager, because you're the one that cares the most and understands the business the most. Often the not knowing where to start means we don't start at all. We're really scared of increasing prices and losing customers, because we don't actually know the customers we can afford to lose. It's just that fear of losing volume, isn't it? But actually sometimes volume doesn't result in profit. Now obviously you've got increasing prices both business and personally, and the figures we are talking about is, obviously we've all been a little bit spoiled with the mortgage rates. So, you know, there's plenty of people that have leveraged up on the basis that it's a 1% mortgage rate, but that will come to an end and have a significant impact on you personally as well. So again, it's something you need to be planning for. And the energy support may only go on for so long. So these are the challenges you're facing, and it's really lonely. And that's, you know, you do need to talk to other business owners. So do stick around for networking after, actually, because it is good to talk to other people that understand where you are. But I think the other challenge is that staff are easily able to find other employment. And I know, you know, it must make all of you nervous if you've got staff, that there is this negotiation point that they can use at the moment. You may well have staff at capacity and are also demotivated, because, you know, for them everything is going up. You know, you look at your supermarket bill, that's where probably most of us spend most of our income. It's all going up, isn't it? And it feels like we're all under pressure. So definitely mental health is a factor at the moment, even with just financial anxiety. So I think it's a really, you know, it's a bit of a minefield you guys are juggling. And some of you may have recruitment vacancies that are not filled. So it's almost like, where do we go from here? And as I said earlier, the crunch point is January 2025. So I want you all to go away knowing that and to start a bit of a plan from now on what you're going to do to combat those bills. But actually, one of the things we've been working on with clients is how they leverage, particularly senior staff within their business or even their own time, to be able to do more at that higher level and gain capacity. So I'm actually going to ask Malcolm just to say a few words on what we've put in place to help our clients just leverage that.
Am I in shot?
Stand in front of the panel.
So some of you might know that we've got an offshore team that works for us. I've sort of done laps around the whole offshoring issue for about 15 years really, working with a couple of other companies and now with a little team of our own. But I thought I'd just get everybody just to stretch their limbs a little bit and stand up. And I'm going to see how many of you I can sit down with 4 questions. So apologies if anybody's going to. So you've got to answer this. Many of you run your own companies. Those of you who work for bigger organisations, I just want you, maybe you're an advisor of some kind. I just want you to think about your favourite client, and I want you to answer this question on behalf of them. Okay. So, first question: you can sit down if you would like more skilled staff within your organisation. I'll sack a few of you down. Okay, you can sit down if you'd like to reduce staff turnover within your organisation, the number of people that leave. Okay. Clearly, some of you standing up want to get rid of several people. Okay. You can sit down if you'd like to lower staff costs. You'd like your staff costs to be less. Okay. All right. Good. I've got rid of most of you. And lastly, you can sit down if you'd like a little bit more time for yourself. Got him. Okay, easier said than done at the moment, isn't it? We've got this perfect storm staffing-wise at the moment. A lot of money sort of flooded into the economy because of all COVID that happened. We've got a demographic problem in the UK. All the baby boomers are all sunning themselves on golf courses with their final salary pension schemes. Generation X are following behind. So we've got the percentage of people working within the country is reducing. Then we've got the dreaded B word, what Brexit has done. That's reduced the number of working people as well, particularly at the younger age bracket. And that's now being felt almost across every single business. There's hardly anybody that I talk to that wouldn't say that they're struggling to get good staff. So the question is, what are you going to do about it? How can you resolve that problem? Well, one of the ways you can do it is by going offshore for some of that labour. Now, our colleagues from the FSB talked about a few of the changes where that would enable people to come to the UK, but that's not practical in many cases. So lots of jobs within your organisations are desk-based jobs, and I think that almost every single desk-based job is capable of being done offshore. Most people would have disagreed with that before 2020, but when we all had to work from home for 6 months, I remember sending an email to my team right at the start saying we're all offshore now. And our working patterns changed during that time to enable people to do jobs in any location, really. The best location that we've found for recruiting staff offshore is Durban in South Africa. Now, Durban's got a number of really big advantages over some of the other locations. The first thing is that most people in Durban speak English as their first language. The second thing is the accent in Durban is almost barely any different from the accent of anybody in this room. In fact, I would I would probably challenge you, if you had 4 people to speak to, one in Newcastle, one in Liverpool, one in Glasgow, and one of my team in Durban, I'm pretty sure you would find that the accent in Durban was closer to your own. So it's also almost on the same time zone as us. There's a 2-hour time difference in the winter, there's only a 1-hour time difference in the summer. Its laws, the South African laws, come from the same start point as our laws come from. And whilst we may have been diverging for 100 years, it's amazing how much is still the same. And what that means is that a lot of their business regulations are very similar, and what that means is a lot of their professional qualifications are very similar. So you've got this fantastic location out there. The biggest 2 differences of all, though, are Durban has 28% unemployment. As a result of that, the salaries run, and cost of living is significantly reduced as well. So salaries in Durban would run at about 50-60% of what a salary in Kent might be. There's also because of that 28% unemployment that we have there, what that means is you've got lots of people within the 72% who are in jobs which are way below their level of expertise or qualifications. So we've got this huge talent pool that we can recruit from. And just to put that in context, about 4 weeks ago, we had 2 positions that we were advertising for clients. So one was looking for a really good admin person with experience, not a school leaver or whatever. And the other was a general finance assistant, somebody who could do a bit of bookkeeping, a bit of credit control, support somebody in the UK. So I asked both of the clients suggested the salary would be about 20k in the UK. I personally think they probably need to go a bit higher than that, but we advertised that at £12,000 in Durban. Those 2 jobs were advertised on a Friday afternoon in Durban, and by Monday morning we had 1,600 applications had come in 3 days. So I close the ad. We can't deal with any more applications than that. The young lady who got the admin position on her CV had worked in Dubai for Ernst & Young for several years before returning back to her home. Now, I don't think you get someone like that for £20,000 in the UK, so let alone £12,000. So there's a big pool of talent there available for all of your businesses to utilise. Now that may be that there are certain positions within your organisation which just naturally fit somebody working in any location. It may be you've got to be a little bit more imaginative in terms of how you use that. You've probably all got people in your organisations that are not brilliant delegators. They struggle to delegate to somebody with less experience than themselves. Offshoring gives you an opportunity to give them an assistant who is as experienced as themselves. So they can have somebody working for them doing, obviously they can only do the desk-based stuff. They can't go and visit their customers. But if you've got a really good assistant who can deal with all that paperwork and is perhaps as qualified as you are, then that frees up you or one of your senior team to spend more time working with getting out and seeing customers, doing the stuff that has to be done locally. So I think the information that we'll send round, there'll be a few more details about it. But if anybody particularly would like me to get in contact, just give me your business card and I'll catch up with you in the next couple of days. So hand back to Emma.
Well, I think where that's become so topical for us is quite often for businesses, they've got someone in-house who's doing finance. And actually, as a business owner, you can never get what you need, certainly in a time frame that it's useful, from the internal finance because they're so busy doing things that are really probably below their salary. They're doing a lot of processing and things, and they're constantly trying to catch up with that side, and it means you never get your headline numbers. You know, a few days after the month end, where you know what your turnover was, you know what your costs were, you know where you are profitability wise. So I think that's why that's really significant for our clients, is we're trying to help them get the key data that they need. So okay, where do you start? Now, your starting point has to be up-to-date accounts, because that will give you at least a summary of where you are. Because without that, you can't even start to know where you need to go to. Now, as owner managers, you guys need to focus on the top half of your profit and loss. Now, what I mean by that is your turnover, so your income coming in, your cost of sales, so what has a direct impact on your profitability, your gross profit, and your gross profit margin. And then what I'd ask you to do is look at where does most of your profit come from. You know, are you providing different products and services? Are some things you do more profitable than others? You know, it's really important for you to understand exactly where your profit comes from and where your profit leaks are. Now, obviously, unless you're doing something that is a loss leader that then gives you other work that is really highly profitable, you know, you need to look at cutting or reducing the low level margin and product stuff that you are doing, because that's how you increase your capacity. You also need to have a real good assessment of who you're working with. You know, what are you providing, who are you working with, and actually, have you got jobs that, you know, you've got one certain customer that's always absolutely hammering you on price, and you're not actually making much money off them at all, but they probably take up proportionally a much bigger percentage of your time than your best customers. So we've got to cut them. The same as you'll be having things where you're over-servicing, and again, you need to assess those jobs and cut them out. Now, Peter is actually a pain in the, and that's the cut. You know, the calls that you absolutely dread and they ruin your day, if that is going to impact your productivity on a daily basis, you need to get rid of that. Because your motivation is what's going to drive the business and drive your team. So, automation and AI is a huge topic. You know, we spend quite a bit of our time working with our clients and their accounts teams on just how easy it is to automate some of the finance processes, to push purchase invoices in without someone spending most of their day tapping in the numbers, scanning in things or sticking them in a file. There is technology out there that can receive it as a PDF, put it in your account system, it's stored, the data's read, and it's in your account system. So they're the sorts of things we're working with clients on. And then it's worth you having a little look, or, you know, if you've got industry bodies that are chat groups, find out how they're using AI to leverage what the team are doing or what they're doing. It's really, really interesting stuff. But I think you've got to look at where you're driving your business in terms of technology. You know, you are going to be able to negotiate the best with your top suppliers. Now, I'm not saying that's hammering them on price, because, you know, obviously you're in partnership, you want long-term relationships, but it's actually talking to them about bulk buying powers. You know, if you're spending a certain amount of money, can you get a bit of a discount? Or, you know, do you not have to store so much stock because they'll keep a little store for you? Just all those things about working together to improve how it's working for both of you. If you've got a team and you've got a plan, you need to tell them. Because actually, if you engage your staff on your plans to grow your business, you'll be surprised how many of them want to help but don't know how. They don't necessarily know how to work their network and talk to them about what your business does and what you're looking for and how they could bring customers in. You know, maybe a little incentive scheme, or, you know, it's making sure everyone is pulling in the right direction and the direction that you're setting. But it might be that they've got ideas that you haven't thought about as well. You know, quite often they see things from a different perspective. So it's really good to have them engaged in your sales and marketing. But also build up your raving fans, your referral sources, you know, who's going to drive the right type of clients to you, so that you've got a bit of an external sales team that you're not having to pay for. And then you've really got to sit down and plan to leverage your time. This is the biggest thing that we find with owner managers, is there's often things that you're doing that you're not the only person that can do it, and that distracts you from working on your top line strategy. So I really would say, you know, there are some things that you do that you just need to put on other team members or not do at all, just to give you the portion of time that you need to carve out to do that. And again, that's discipline with your diaries as well. It might be that on a Tuesday morning for the first 2 hours, no one puts a call through to you because you need to spend some time working on a bit of a plan. So how can we help? During COVID, we felt it was our responsibility to save as many businesses as we could. It certainly felt like before the tax incentives and the government support that came out, that there were some really terrifying numbers going about, and certainly in my head I felt that had the support not been there, it would have halved our client base, you know, overnight. So we spent a lot of our time doing our job during the day, interpreting the news when everyone else switched off their computer, and releasing a daily newsletter that meant this is what you had to consider next. Because quite often what they were telling us was not everything we needed to know. So we felt it was our duty to help protect owner managers' sort of mental health and from freeload panic, and to just give you an action point for the next thing to think about. We're doing exactly the same now with our Challenging Time Support Hub. We're working on free tools and free advice to help guide you in the right direction. So definitely make sure you're signed up to our newsletter if you're not already. We're also going to release a series on kind of the staffing crisis and what you could be considering with your staff. Because again, we feel like it's a big area that's going to hold businesses back, is being able to leverage those people internally and keep them motivated. For a lot of our clients, we help them work on their break-even calculation every year, which is almost, we work back from what the owner manager wants or needs to live on, and we'll also assess, you know, what are they doing with that money. So, you know, stop them from making crazy mistakes like paying super rate tax to overpay a 1% interest mortgage, you know, sensible things like that. So we get them into a good financial position, and we work backwards to a turnover figure, and then we help them break that down between, as far as daily sometimes, or monthly or weekly, and vary it for the months, because we all know nothing happens in August or December. So, but that's really, really important. So we would always encourage people to look at that as part of their planning every single year. We offer a free Xero health check. So Xero is a cloud-based accounting software, if you don't already know it and use it. The reason we recommend that one is because there are a lot of add-ons that work with it to improve automation within finance departments. And it's really easy to design reports that you want and get the data out. So we will offer a free Xero health check, just so that we can make sure that there's not any silly little mistakes that you're doing where you're sort of losing an opportunity for the software to work better for you. Changes to your accounting systems. So we do this a lot for clients, where we're constantly evolving the way they report. So you don't get sales type A and purchases. What is that? You know, how are you meant to control that if you can't see it and understand it and break it down? Then we train a lot of clients on how to manage cash flow. So we've got some really good tools on cash flow, and we'll train them how to use it so they can constantly be updating it. And then for a number of our clients, we act as sort of a virtual FD. Sometimes we're just basically an accountability buddy. It's like, these are the targets you've set, this is what you're going to do, and we're going to tell you whether you're meeting those or not. And sometimes it's just having that person to talk through things with, just means that you're taking time out as well to focus on the numbers. So I'd like to open it up to questions and stuff, because I'm sure you've all got loads buzzing around, and feel free to fire it at any of us that have presented. Has anyone got any questions they'd like to raise? God, have we panicked you into silence?
I've got one. Spoke about using overseas talent. What about contracts, like employee contracts, security, things like that, please?
It's not for me, really.
Yeah.
So South Africa's got some interesting employment laws. Just when I stand there, I'll just get the glare right in there. So we're viewed as a labour broker. The way we've structured it, we have a UK company, which is the one that invoices our UK customer, and then we have a South African company, which is the one that employs each of the individuals. South African law views us as our two companies as labour brokers, so it actually sees the employee as having two employers. The de facto employer, which is our company in South Africa, because that's who their contract of employment is with, that's who pays their wages, does the pension contributions, etc. And their real employer, which is the company in the UK. So to all intents and purposes, practical purposes, if you took somebody on, they would be your employee. And actually, South African law would recognise that, albeit that we're doing all the technical, complicated bit. Their employment law is very similar to ours. There are one or two instances where it would favour the employee compared to the UK, but there are quite a few other ones where, as an employer, you would say that it's probably better than in the UK. It's a little bit more regimented. You know, if somebody's not working out, it's not as painful a process that you've got to, you know, how drawn out it can be. If you've got an underperforming member of staff in the UK, just follow the right steps, and might be a little bit of money to pay to somebody, but you know, not the same as it would be in the UK. Does that answer?
So that's done through your company?
Yeah, we have it's set up as a separate company. Durban Offshoring is the company, and we have Durban Offshoring Pty, which is the South African subsidiary.
Thank you.
Yeah. Does anyone else have any other questions?
Yeah, we're going to be fitting out our office this year. Can you explain the capital allowances versus super deduction? What's actually changed?
So if you're fitting out your offices, there'll be an element, some part of that expenditure, if you're changing walls and things to do with the building, there'll be capital today. You wouldn't get a tax allowance on the structural elements. They would sort of go onto your balance sheet, and at any point you sell the building, that's when you'd realise those costs against profit on selling the building. But anything that's fixtures in that development, any equipment that you put in, and in theory some of the fit out, different cabling that you might need to run or whatever, those elements would then be allowable for tax purposes. So up until the end of this month, you could get the super deduction on some elements. So say you bought a big bit of kit to go into a new room that you've got there, or you've got a new computer system you put in, you'd get that uprated by 30% for tax purposes. After the 31st of March, that relief disappears, and we go back to the annual investment allowance, being the primary one for small businesses, where they would just say, right, the whole cost of that, the £10,000 you spent on that computer system, all of that is allowable in the first year, even though for accounting purposes, we would show that written down over a number of years so that the cost offsets the income it's helping generate. In the seesaw of tax planning versus finance, that's the perfect storm, because you get all your tax relief up front, yet you're still showing a higher profit on your accounts, so that the bank's happy, basically.
Is there any benefit in us pre-purchasing some of this kit before the end of the tax year?
Before the end of the 31st of March. There is, yes, if you can get that, you can put it into storage somewhere in your business whilst you wait for the room to be ready for it. There could be benefit there for getting that pushed forward. Depends on other things like when your year end falls and things like that, and how it's accounted for. But yeah, I think there is benefit to try and get that in the next week. Does that help?
Okay, excellent. Well, I think hopefully you've all taken away the fact that really it's all about planning. It really is about looking at your numbers, knowing them, and constantly focusing on a plan, and with that kind of discipline for you guys to actually carve out that time, and not get distracted by all the other things that all the other fires that are going on. So do stick around. We're going to have networking in the other room, but obviously keep in touch with us. We've got, as I said, we've got loads of information on our website. We've got a newsletter that goes out regularly. We're always happy to talk to people who need a bit of help and advice. So, and we've got a feedback. I'm getting my prompts from over here. We've got, please scan the QR code that's in your goodie bags for feedback, because we love to know how you find these events. We're really grateful for you all turning up this morning, and we'd love to know what other things you're worried about, because then we can plan future events. All right, well, thanks very much.